interest rates really are kind of like the biggest lever that if anything moves, it's de facto going to change housing prices. That being said, are you just sitting in the sidelines saying we don't know what interest rates are going to do, or are you out there kind of like trying to think of what's happening? Where do you get good advice on like where things are going that you do pay attention to, GC?
I pay a lot more attention to what's going on locally. I think
Mm.
that's what really matters. If you're an investor and you have your money in a market, either you or the team that is managing your money in that market should really know exactly what's going on as far as pricing, as far as months of supply, making sure we understand where inventory is. If we start to talk a little bit more about what's actually helpful here, it's more of the individual market. We could talk a little bit about Jacksonville. We did that right on this Jacksonville real estate market report and on the market update, but we can kind of hit some of those things. I think that's what's most actionable here. And what we're finding is specifically in Jacksonville, what we're experiencing is this, what we've kind of coined this coil effect, right? Higher for longer interest rates are suppressing housing demand that otherwise would be there, but it doesn't eliminate it. And so our home prices in Jacksonville have actually gone down about 1.5% this year, which is unusual. It doesn't usually happen that way, especially in the summer months. But all that's happening is it's just the coil effect. It is suppressing or pushing off demand that otherwise would have been here for home sales. And those people still want to buy homes. So as soon as interest rates do get some relief, you're going to see mortgage applications go up. You're going to see more home sales. And then you'll see increased home price appreciation and making up for the years where home price appreciation has been lean, mainly due to the higher for longer interest rates.
The coil effect. I feel like I should go back and explain that a little bit. We can actually use some of the data from the quarterly market update when we talked about this idea that last time that interest rates dropped this much for this long, we have a really good comparison, right? In 80 to 82, interest rates in 2 years increased for the same amount that they've increased now. The percentage in actual sales volume decrease the exact amount, right? So same amount of time, same amount of interest rate hike, same amount of decrease in sales, right? Not in pricing. So very, very one to one what happened in January 80 to August 82 to what's happened in the last couple of years here in this economy. And then when you look on the other side of it, once interest rates started to come back down, there was much higher than normal home price appreciation, 4% gains the following year and 4.8% gains the year after that. So what we call the coil effect is the idea that when interest rates stay high, it is not that it's taking away demand, it's that it's delaying it. And what it's doing is kind of like a winding coil that the longer it winds for, the more compressed it gets. When the pressure relief happens in the coil, bang, springs, then you get this like increased demand, this increased home price appreciation, and a bevy of sound noises that I like to make with my mouth.
Well said and well sounded out. I think you did that quite well.
Thanks,
So
man. Thanks. So the coil effect, right? So that's what we see happening. It's not just supported by when you talk about a local market that you know very, very well, the coil isn't just a interest rates are suppressing stuff. We're also looking at indicators like average wage growth that's really happened a lot in Jacksonville, net people moving here, that's really happening a lot. You want to talk a little bit about those indicators?
yeah, absolutely. Let's just say that interest rates stay the same forever that they are right now. You want to look at other things that are going to drive housing demand, which ultimately drives home price appreciation, rent price appreciation. And we need median incomes to go up to support all of that so that our homes are affordable. And if you're thinking about where to put your money, it's just really simple. Just look at the places where population is growing. That's the easiest thing you can look at. When you're looking at population growth, you're also seeing that median incomes are rising. You're also seeing jobs are going up. You want to make sure it's a strong economic base before the jobs are rising. But yes, you're seeing jobs going up. And you want to make sure you're in a market where you have at least 1 million people living. So these are just some basic things. If you're thinking about where to put your money, you're going to win in the long run in rental property investing. Look to put your money in those places where people want to be, where people want to move, because all of these things, independent of interest rates will be whatever they are. The way to win in the long run are those markets where population's growing, median income's going up, the job base is strong and it's growing as well.
Totally, man.